In this video, I'm taking a look at how to trade exponential moving averages. So a moving average is one of the most common indicators that you will see in technical analysis. And a moving average looks basically like this. It's a squiggly line that goes up and down. And what it is a mathematical equation that's being figured out for you. It's plotting every time there's a candlestick formed. And then it connects it all, so it just looks like a line. And the idea is it gives you the trend. It shows you if perhaps momentum's picking up, that type of thing. So in order to do this, you need to click on Indicators and Strategies. And you can type in EMA, which Moving Average Exponential. I'm going to put 4 on the chart for the purposes of this video. I'm going to go ahead and click these eyeballs. And on this one, on the EMA, Exponential Moving Average, 9 period based upon the close, I'm going to change the color to blue. And okay. And you can see that the moving average does in fact go up and down with the average price of the close of the candlestick. Obviously, prices are rising here, so you would expect the 9 EMA to rise right along with it. You can also put other moving averages on. So, for example, let's go to this next one. Click Settings. Change the color to red, make it a little bit more easy to see. Inputs will change to 20. So this would measure the last 20 candlesticks. It's a little slower, and therefore it gives you a little bit of a longer term outlook. Now, there are a multitude of ways to use moving averages. So, for example, notice that the 20 seems to be offering selling pressure, and then once the market breaks above it, it seems to be offering support. That's known as dynamic support and resistance, and you'll see it time and time again. The 20-day, in this case, moving average, is one that a lot of people pay attention to. There's also a crossover system, and this is probably one of the oldest trading systems out there. And what happens is one of these moving averages will cross over the other. Obviously the 9, the faster moving one of the two, does the crossing. It drops below the 20, and that's a sell signal. And what that tells you is that momentum for the short term is starting to accelerate to the downside, and the longer term kind of goes right along with it. The idea is that if the faster moving of the two moving averages breaks down below the longer term one, then it is a sell signal, just as this would be a buy signal. Now, it's entirely up to you whether or not you do it in the old classic sense, where people would literally sell, buy, and then if it crosses again, sell. They were always in the market. There are some ways that you can filter some of the noise. So, for example, this cross here, some traders wouldn't have taken that until the two moving averages spread further apart. That shows a divergence, if you will, of speed. Because the moving averages are relatively flat there, that shows that the market is not really going anywhere. But once it did accelerate to the upside, you can see that the moving averages spread out apart. There are a couple of special moving average crossovers, and I'll go ahead and show you those now. In order to see these, we will need the 50-day EMA. I'll go ahead and paint that orange. Let's go ahead and put that on. And then this one will need to be the 200. I'll make this black. So this is 200 days. So they have something known as the golden cross and the death cross. The death cross is very bearish. Golden cross, as you would expect, would be bullish. And that is a moving average crossover when the 50 crosses over the 200 daily moving average. Specifically, it's just this time frame and just these numbers. Just as the death cross is 50 crossing below the 200. So if you hear those terms, those are exactly what they mean. It doesn't happen on the hourly, it doesn't happen on the weekly, it only happens on the daily. The problem with this, of course, is that it is such a high time frame. They are such large numbers that, as you can see, you may get whipped around in this case, but when it does work, it tends to work for a very long period of time. You would have gotten in back here, and you wouldn't have gotten the exit signal until here. So a pretty long amount of time to get involved. Quite often what people will do is they'll use something like this to confirm, maybe like a breakout or something in this case, some type of candlestick formation, which of course we'll cover those later, to validate that type of setup from a longer term perspective. There are a multitude of different ways you can use this. So let's go ahead and put a couple on this Litecoin chart. So this is a daily chart. So let's use a little higher time frame one. Let's go with 50. We'll make that red. Let's go with black on the 200 on the daily. And this sets up an obvious up and down trend type of situation. You can see that we got a death cross there. And certainly that was a selling opportunity. Again, though, not a big fan of these, just simply because for the most part, they don't work, to be honest with you. You get massive gains or you get stopped out with a loss. It's kind of nowhere in between. That being said, though, when you look at this, you can see that the 200-day EMA did offer a certain amount of resistance and then support. A lot of traders will simply only buy or sell depending on which side of the 200-day EMA price is. Or, in this case, we've had the golden cross, so that tells you that the 50-day EMA is letting you know that shorter term momentum is to the upside. So then you start to look for buying opportunities. An example might be to use, like a Fibonacci retracement. We've broken to the upside. We've come back to the 50-day EMA. Let's go ahead and put a fib there, and you can see it's right at the 50%. It's between the two moving averages. Price has been caught, and it extends its way higher. We break significantly below the 50-day EMA on this particular day. Could give you a little bit of a heads up as to time to get out. In the next video, we'll take a look at how to trade something called MACD, or Moving Average Convergence Divergence.